Welcome to Catalyst. I'm Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the outlook for interest rates and what that could mean for your portfolio. Plus, recession risks on the rise on Wall Street. What are the signs to watch for? And what does it mean for the market? And investors digest looming tariffs coming as soon as next week. We'll look at what that means for consumer sentiment and businesses. Half an hour into the U.S. trading day, let's get a check on the markets here. You've got your tech-heavy names still weighing on the NASDAQ, down about 0.2%, a tenth of a percent, waffling around a bit. You got your S&P 500 up nearly 0.2% here. You've got your Dow holding on to gains as well. All week, we've been seeing the Dow and the NASDAQ trading places. If one is up, the other is down. Again, those tech-heavy names being really dragged down by the likes of NVIDIA. You've got some of your other Mag 7 names, though, like Meta, still leading the pack when it comes to the upside. But let's flip the board over to the bond market because you've got the 10-year in particular. The yield on the 10-year on track for its seventh week of declines here. Yields continuing to be under pressure. The question is whether or not the Treasury market is pricing in a growth scare moving forward, or if this is a sign of continued economic expansion that the president and his team are trying to usher in. We're going to ask that question to some of our guests in the show today. But finally, I want to take a look at gold because gold is on track for its worst week of the year. You can see the pressure gold is under, but it's not the only commodity under pressure. Though in the digital asset space, we've got Bitcoin down today, nearing that 80,000 key level. If it dips below that level, a big question as to how low it could go moving forward. Though I should mention it is still up about 18% since the election of Donald Trump. Well, U.S. stocks are set to wipe out year-to-date gains as investors grapple with hotter than expected inflation, looming tariff threats, and an uncertain rate environment. So how can investors best position? Joining me now with more, we've got Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, great to have you. There's obviously so much uncertainty in this market right now. Where are you finding the most conviction?
Well, I still see a lot of conviction among individual investors who have been very successful over the past few years at buying dips and following momentum trends. They're still believers in this rally. I think on the flip side, though, you are starting to see a bit more nervousness creep in, certainly from institutional investors, and some individual investors have started to waver in their resolve about buying stocks lately. The sentiment has definitely soured among consumers, and it's sort of almost, you could bifurcate the market now into investors sort of view, they have this wealth effect from all the money that good investors have made over the last couple of years. It's been phenomenal 2 years, certainly. But then there's all the other consumers who are not investors, and ultimately those consumers who are feeling stretched start to weigh on the market and the economy as a whole.
And to what extent do you think we are heading towards an economic slowdown that one could describe as a recession? And if you do think we're heading towards that, then what trade might that initiate?
Well, I do think that I'm not going to play economist here. That's a little out of my bailiwick. But what I will remind everybody is GDP, which is a recession is basically the short version is two successive quarters of negative GDP, which we have not seen yet. But remember, GDP is consumer plus investment plus government plus net exports. Well, we've had a period where fiscal spending was huge. It led to inflation, it led to some other things, but it also really helped GDP. Well, now you take the G in the equation, throw it into reverse. That also has multiplier effects, and it's starting to spook the consumer, which is the C. So both of those can really start to weigh on the GDP even more than the net exports, if they are helped by tariffs, which can be an open question. Is enough to bail that out, and I don't know that it is. And the fear here among a lot of investors now has become that the economy could be slowing down faster than the Fed is willing to react, which is a tough situation. Which is why you alluded to it just before, that the Dow is doing better than the S&P, and those are the stocks, the non-tech stocks, the more defensive plays, which tend to be a bit overrepresented not overrepresented, they're represented differently in the Dow Jones than they are in the S&P 500. Those stocks are doing better. Consumers, even though I said consumers are weakening, consumer staples tend to be doing well. consumer discretionary is not so good. In general, right now, this is an environment either to lighten up, raise a little cash, which considering the cash is still paying you 4% is not a terrible place to be. But if you want to stay invested, you may want to move a bit more toward low beta stocks and high dividend stocks because they're a little more insulated from the market's risk-off mentality right now.
Yeah, it's a great point, Steve. And I wonder how that impacts positioning when it comes to those large cap tech stocks. It feels like we're asking investors to break up with their stable boyfriend from the past 2 years that's given them double-digit gains. So what are they supposed to do?
Well, that's the problem is people are reluctant to do it. And we see among some of our customer numbers, which let me be very clear, I have very limited visibility into our customer activity for for reasons that are good for the customer. But what I can see is they're still not breaking. A lot of our most active customers are not really breaking up with that good boyfriend they've had. We continue to see net buying in things like Tesla. We've seen it in basically most of your Mag 7 names. I mean, among the 25 most actively traded names, when I looked yesterday, 24 of them were still to the buy side over the past week. So, I do have to wonder whether buying the dip, which has been a phenomenal strategy for a lot of people, particularly in the last few years, but it's a strategy that's worked, probably for thousands of years. You do have to wonder a little bit, at what point does it become sort of more of a trying to catch a falling knife than it is, buying a dip? Because you do want to buy dips when the trend is in place. You don't want to buy dips when an uptrend is not in place. That's actually when you sort of try to flip the opposite mode, and that's sell rallies and then buy the dips. So it's tough to say when a trend has definitively changed, but I do get the feeling that some of the uptrends, or at least if not changing, they're taking a breather right now.
And Steve, I want to end on one trade that I really associate with you, and that is buying volatility. In this environment of such uncertainty, how are you sitting with that trade today? Should investors be thinking of owning more volatility?
I think I just basically said don't always buy dips, but that's one thing I think right now you do want to be aggressive at buying dips. What you see with VIX and other volatility measures is, they have their ups and downs, and they've shot up higher recently. I'm not sure that volatility here is a great buy at 21, but if it starts to come down to 16, 17, and you don't necessarily feel that the risk mentality is completely changed in the market, that's a time to start thinking about adding volatility to your portfolio. I also never think it's a bad idea to think about protective hedges, downside puts, that sort of thing. Again, they've gotten a bit more expensive, but they're not, at least on individual stocks, they're not necessarily prohibitive. And so that's something else to be considering. But that's got to be on a very specific case-by-case basis.
All right, Steve Sosnick, thanks so much for hopping on with us this morning. Always appreciate having you.
Great to see you, Maddie.
Thank you. You too. Coming up, we're going to take a look back at February, including the member of the Magnificent Seven that's on pace for its worst month ever. We'll get you that stock next. It's now time for some of today's trending tickers. Scan the QR code to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, shares of Tesla slightly higher this morning, up nearly 1%. Despite that, the automaker is on pace for its second worst month ever. Out of the 19 trading days for the month of February, Tesla has so far ended lower on 14 of them, notching losses of near 30% for the month. Now, Tesla notches a seventh straight day of losses. It would match its longest ever losing streak. As a reminder, Tesla's worst month was back in December of 2022. That followed CEO Elon Musk's acquisition of Twitter. It's now X. Investors are currently worried that Elon Musk's focus on the government sort of mirrors the way he was distracted with that Twitter purchase. And in an interview with Yahoo Finance, Ross Gerber, he's a longtime Tesla shareholder and CEO of Gerber Kawasaki Wealth and Investment Management, he said Musk might have become a problem for the company. Take a listen.
But the truth is people identify with their vehicles and people don't want to identify with Elon Musk. And unfortunately, they take that on Tesla. And so it's been a tough year for Tesla shareholders. And I don't see it getting better because it's still trading at over 100 times earnings.
And we should also mention that those EV sales in Europe are also part of what is driving some of that downward pressure on Tesla stock. Taking a look at the consumer discretionary stocks for the week, Tesla is the worst performer, but another automaker is the best performer of that basket in the week to date here. You've got General Motors up 5% on the week. That, to me, goes to show that it's not all about policy coming from the Trump administration. You would think that potentially auto tariffs would weigh on a stock like GM, but their dividend and share buyback announcement was enough to get that stock up on the week. Meantime, again, you've got Tesla down at nearly 17% over the last 5 days. Of course, we'll see how they do heading into the close. Shifting gears here, a commodity we are watching: gold, precious metal on track for its worst week of the year as concerns over President Trump's tariff plans, with those 25% tariffs on Mexico and Canada and an additional 10% tariff on China, are set to take effect on March 4th. Joining me now with more, Yahoo Finance's Inez Ferre. Inez, what's driving this pressure on gold?
So, Maddie, you have a couple of opposing forces here. You have the tariffs issue, which the tariffs issue is definitely weighing on gold because this strengthens the U.S. dollar. So if we take a look at where the U.S. dollar is today, it's sitting up above 107. When the U.S. dollar goes up, typically gold goes down. So we are seeing gold under pressure today, down more than 1.5%. So this is now snapping an 8-week rally for gold, because now gold is on pace for a weekly loss of about 3% over the last 5 days. But look, gold has made 9 record highs in February. Year to date, it is up more than 7%. A correction was overdue, some analysts are saying, because you had gold rallying 27% last year, almost 27%. Then you had these record highs this year. But so this was a little bit overdue, but that's not changing the base case for analysts, which are seeing gold that is supposed to hit $3,100 per ounce, according to Goldman Sachs, by the end of this year. And you have that economic uncertainty. So if yields start coming down, if the Fed does this year cut rates, that will be bullish for gold, because gold does better in a lower interest rate environment. And overall, tariffs are still protectionist, and so central banks have been flocking towards gold. You saw last year a record amount of central bank buying, with the fourth quarter really accelerating, and all of that being led by China. And you've had ETF inflows, except that's been reversing over the last week or so. But nonetheless, that doesn't change the base case for a lot of analysts that are saying that that you are going to see gold going higher, but this is certainly a dip, an air pocket, so to speak.
All right, Inez, thanks so much for breaking that down for us. Certainly a commodity that investors have paid a lot of attention to and has led to a lot of people making money. So interesting to see those losses there. But let's take a look over at the stock market here. You've still got the S&P 500 moving to the upside, though. It looks like the NASDAQ has flipped into positive territory, and you've still got the Dow moving to the upside as well. Now, all 3 major averages are set to close out February in the red. Joining me now with a look at the past month and what the market may bring in March, it's markets and data editor, also co-host, not co-host, of Stocks in Translation, Jared Blickery. Sorry about that, Jared. Take it away for us this
I've
morning.
got some help, and you've helped me as well, so I'm very appreciative here. Let's take a look at the S&P 500 in the month of February. Only 19 trading days this month. Usually you have 21, but it's a short month. But not the best results. You can see down 2.7% over those 19 days. NASDAQ was down more, but we're going to focus on the kahuna here, the S&P 500, because we've been tracking seasonality estimates using data going all the way back to 1928. And although the month of February ended up a little bit to the downside, it wasn't a surprise. We kind of expected a rise into the middle of the month and then a fall, and that's actually exactly what happened. So here is our S&P 500 2025 seasonality map, which I've shown before. What's new is updating in green here what has actually happened. And this is so closely tracked the back half of February that you almost can't see. Those lines are overlapping here, but we are back down to 0. So in fact, as we sit here, the S&P 500 down less than 1% on the year. So then what happens in the month of March? It's basically this little slice in here, and yes, we blew it up for you, and we have 2 seasonality maps. So this is the white one is a continuation of what we were just watching, and that's one that has worked really well this year. That sees a rise in the early part of March, only to decline into the half, a little bit later than the half, and then a rise into month end, but critically ending a little bit negative there. Now, this is the same day of week method that I've been using, and this goes back to 1928. So for instance, today is Friday the 28th of February. We would only use those dates in this calculation going all the way back almost a century. Now we have another way of doing it. This is a more common way. It's a little bit easier, and so this is going to be probably more what you see from some of the other analysts out there. But this is the average in green since 1990. What this shows as a potential is a dip into about March 10th, March 12th, and then a rise into the end of the month with a few squiggles there back and forth. But for the most part, that's a more desirable outcome. So we'll have to see what happens here. But again, the white has been tracking what we've been doing pretty closely in the month of January and February. So here's the whole year again. Just want to show you that in April, the clouds start to clear. We have a few zigs and zags in the summer, and then we get into prime time volatility season in the later part of the year in October and November. We see some potential headwinds there, but I want to couch this and say seasonality is only a tendency. It accounts for up to 1/3 of price action, and we can see things override it. We have a lot of catalysts this year that could potentially do that, but we got to pay attention when things work, and we'll have to see how this works out in the month of March now.
Yeah, we certainly will, Jared. Thank you so much for breaking all of that down for us. We appreciate it. As we head to break, I want to take a look at shares of Intel on reports from the Columbus Dispatch that the chip company is delaying its Ohio chip plant until potentially 2031. Now, this comes after the company received $1.5 billion in federal funding back in November of 2024. That was after a 2-year-long stalemate with the government. That facility was expected to be operational by 2030, which was already 6 years behind schedule. Now that looks to be behind schedule again. The company promised the Buckeye State at least $20 billion for a semiconductor manufacturing plant that would create tens of thousands of jobs. Yet thousands of union workers have been waiting to continue that construction. You can see shares of Intel up over nearly 4.5% this morning. It is one of the best performing chip stocks of the week. And I also want to mention that we've got the NASDAQ flipping into positive territory right now. Intel is the 3rd best performing member of the Invesco QQQ ETF that tracks the NASDAQ. So it's interesting to see that outperformance off the back of this news of that plant still continuing to face more delays. We'll be right back here on Yahoo Finance with more markets news that you need to know. Stick with us. Fears of a recession growing on Wall Street as data starts coming in below expectations, indicating a potential slowdown. Joining me now, Neil Dutta, Renaissance Macro Research Head of Economic Research. Neil, great to have you. I know you say that much of what we see in the financial press, like tariffs, uncertainty, you call that a red herring for an economic slowdown that was already in motion. So what do you think is driving that slowdown?
Well, thanks for having me on, Maddie. I think it's primarily a function of monetary policy being too tight. I don't think people are pulling back, signing contracts on new and existing homes because they're worried about tariffs. I mean, think about that. So we know that new home sales have softened. Pending home sales are at new lows. Those represent signed contracts. And so that probably bleeds into residential investment over the next couple of months. And I think it'll in turn also weigh on residential construction activity, of course. And then when you think about incomes, I mean, the labor markets have been slowing for a while. If you look at quits rates, they have been low. Recruiting intensity has been low. And so inevitably, that's going to lead to weaker income growth. We're seeing that. And while DOGE and tariffs and all the rest of it gets the most attention, the truth is that state and local government spending and investment's been slowing for some time now, and that's projected to continue to slow into the next fiscal year. And that had been a major source of growth up until recently. So, to the extent that tariffs matter, I think that adds to the anxiety, but I don't think it's the principal cause of the anxiety.
So where does this leave our economy? How likely is a recession, in your view, for this year?
Well, it's hard to pencil in the recession call because the Fed has so much ammunition to deal with a meaningful economic slowdown. But it doesn't mean that you can't see a growth scare. So I think recession risks are rising, but I think once the Fed gets on the right side of the eight ball, those recession risks will decline. I mean, it's not unlike the period between June of last year and September of last year. If you recall, I mean, the Fed went peak hawkish in June, and then 3 months later, they're cutting 50 basis points. But I also reject the premise that the markets are actually really, I mean, this is not a growth scare trade, okay? I mean, this is largely just a momentum unwind. I mean, a lot of the winners are now being punted. If it was a real recession story, I mean, you'd expect financial stocks to be underperforming. You wouldn't see Europe outperforming. And there's a lot of things going on that are not really consistent with the growth scare. But what it does suggest, I mean, it's just another sort of notch on this idea that people are just trying to rationalize ex post something that was going on anyway. So they're trying to find, trying to fit a narrative to the data. But, I think if you peel back the onion, it's not really a recession story. To the extent that that's still out there, that means that there's more downside to the markets because that hasn't really been priced in. So I reject the premise that this is a recession fear story. This is a momentum unwind story more than anything else.
And I hear you when it comes to the impact of policy, but when I interview CEOs, they're all telling me that they're holding off on things like hiring, investing in the company, because they're waiting on clarity about not only tariffs, but the sequencing of policy, whether or not we're going to be getting the negative impacts of tariffs before the positive lift of those tax cuts. Do you completely discount the impact of those policy shifts?
Maddie, when things are going well, it's my growth strategy. When things are not going well, it's the economy and Washington, D.C. What did they think they were signing up for when they donated money to this guy's campaign?
I think they thought they were signing up for gains.
He ran on tariffs. He ran on that being his most favorite word in the dictionary. Now they're all surprised that he's going out and doing it. I mean, give me a break. It's just ridiculous. And also, more importantly, uncertainty would be high regardless of who was in office, because the Congress would have been evenly divided anyway. So I mean, would they be holding off if Kamala won and there was a potential tax cliff at the end of the year with corporate taxes going up substantially? Right. So it's, it's sort of like crocodile tears, in my opinion.
No, I understand and take your point on the policy positioning on either side of the aisle there, though I do wonder where that leaves investors if they are to follow your view that this slowdown is coming and that it's an unwind of the momentum trade. And I know you're an economist, but how should investors be thinking strategically about their positioning in this environment?
I think the way you should be thinking about this is trying to tune out the noise from DC and focus on the here and now. And what that means, in my opinion, is that the main risk to the economy is a passive tightening of monetary policy. Right now, the Fed seems to be playing a game of chicken with the administration. They're holding off on doing anything because they want to wait and see what happens with DC. At the same time, they've already been overestimating the strength in the economy. So there's a risk that by sitting back and waiting, and not doing anything, they're basically watching the economy slow down needlessly and not stepping in to stop arrest the slowdown. If you have a passive tightening of monetary policy, that'll put further downward pressure on economic growth and should push investors to take more defensive positions in the equity markets, in my opinion. That might mean consumer staples, maybe utilities. I'm not an equity market strategist, but that's sort of how I'd be thinking about it. And also to take long positions in the Treasury market, because ultimately I think the Fed will do the right thing, but there could be some pressure between now and then.
What is your outlook for the Fed this year?
I think they'll start cutting in June, and I think they'll end up doing more than what's priced into the markets at the moment.
And what do you think will be the catalyst for those cuts?
Weaker nominal growth. It's going to be very odd for them to maintain the same baseline of 2 rate cuts if they're revising down GDP growth and inflation at the same time.
So you anticipate a slowdown in that GDP growth coming sooner than the market might think?
It's already happening. Real personal consumption declined 0.5% in January. It's going to take a lot in the next couple of months to make up for that. Housing is still slowing. and and government spending is slowing. So remember, consumption and government were the two reasons why GDP sort of did really well in 2024. So how you think about those two things are going to have important sort of implications for how you think about this year. And real incomes net of transfers rose 1.5% over the last year. That's half the pace of consumption. So it just tells you that a lot of the driver of consumer spending in recent, over the last year has just been a drawdown of the savings rate. It's not sustainable. And as I mentioned, state and local governments are pulling back. So, that is going to prompt, I think, ongoing downward revisions to economic GDP expectations.
And really quick, as we end here, Neil, I want to get your take on the labor market. I know you see it weakening, but for those people looking for jobs who are listening and feel like the market's just been in a holding pattern, what do you think is going to cause that bigger crack in the labor market this year?
I mean, I think look, if you have a job, things are okay. If you're looking for one, things are not so good. And I think that's the challenge. I mean, if you think, unemployment, a lot of what's going on the unemployment side is really, it's taking longer for newly laid off people to transition into work.
Right. And,
that's why you have this kind of linear increase in the unemployment situation. Now, if there have been, at the margin, it does feel like layoff announcements have been going up. I mean, even irrespective of what's going on with Doge. I mean, Starbucks, you saw Southwest corporate laying people off. Mm-hmm. Autodesk reported layoffs, or job cuts are coming. So at the margin, it does feel a little bit worse. And I think the risk is that, if you get some modest increase in layoffs, you can get some pretty weak employment reports at that point because the hiring numbers are so weak, right? So it doesn't really take much in the way of layoff increase to kind of precipitate much weaker employment data.
Neil, I love that description of the job market. If you have a job, things are, well, okay. Neil, thank you so much for joining us this morning. Really appreciate it.
Thank you, Maddie.
Investors, they're bracing for a busy week of commentary from the Fed following the latest inflation reading. Now, this comes after the Fed's preferred inflation gauge, core PCE, came in line with expectations, showing inflation rose at a modest pace in January. Yahoo Finance's Jennifer Schomburger has a closer look at the Fed speak on deck. Hey, Jennifer.
Good morning, Maddie. Happy Friday. That's right. A better reading on the Fed's preferred inflation gauge this morning should offer some relief to Fed officials after an inflation reading earlier this month on a different measure raised questions about whether inflation was heating back up again. The question now is, will inflation continue to fall? This week, we heard from Richmond Fed President Tom Barkin and Kansas City Fed President Jeff Schmid, who both offered lessons from the 1970s, where if you back off inflation too soon, you can allow it to reemerge. There's also uncertainty about whether tariffs could add upward pressure to inflation, and uncertainty just around the tariffs themselves and whether that could weigh on growth, a major reason why Fed officials have opted to hold rates steady for now. Tonight, we will hear from Chicago Fed President Austin Goolsbee. He will speak quite late here on the East Coast at 10 p.m., speaking on productivity growth and monetary policy. Then next week brings the last week of Fed speak before officials enter their 10-day blackout period before their 2-day policy meeting on March 18th and 19th. Monday, we will hear from St. Louis Fed President Alberto Mussolem. Tuesday, New York Fed's John Williams and Richmond Fed's Tom Barkin both speak. Thursday brings Fed Governor Chris Waller and Atlanta Fed President Raphael Bostic. Friday rounds off the week with a slew of speakers. New York Fed's John Williams again, Fed Governors Bowman and Kugler, and the big one, Fed Chair Jay Powell. Fed officials widely expected to hold their benchmark interest rates steady at their policy meeting on March 19th. The bigger question, Maddie, is whether they scale back the 2 interest rate cuts that they have penciled in for this year amidst all of this uncertainty. Back to you.
And we're certainly going to be monitoring that dot plot to come as well. Jennifer, thank you so much for joining us this morning. Appreciate it. Coming up, fresh tariffs on Canada and Mexico, plus a new levy on China set to take effect this upcoming Tuesday. We'll discuss the latest negotiations and consequences to come right here next on Catalyst. Stick around. China has vowed retaliation against President Trump's extra tariff threat. A spokesperson for the Ministry of Commerce warning China will take all necessary measures to defend its own interests if the U.S. moves ahead with that additional 10% tariff on the nation. Trump confirmed Thursday that the extra levy on China, along with that 25% tariff on Mexico and the other on Canada, will go into effect on Tuesday. Joining us now to discuss, Mark Bush. He is professor at Georgetown and former trade advisor to the U.S. Department of Commerce. Mark, it's great to have you on. I just want to start on Mexico and Canada, and I wonder how you're reading the tea leaves here. The market would love to see those tariffs come down from 25% come Monday and Tuesday of next week. Do you anticipate that?
I think he's going to invoke the tariffs on Tuesday. He more or less has talked himself into a corner, and for a number of reasons, I fully expect that we will see the tariffs on Canada and Mexico go in, and I seriously doubt that anything can be struck between now and then to give Canada and Mexico another 30-day reprieve or even longer.
Well, that's interesting in the context of what we saw with the UK Prime Minister this week, who did have some success negotiating. And I want to take a listen to some sound here and then get your thoughts on the other side from this conversation.
Mr. President, did our Prime Minister persuade you not to put tariffs on the UK?
He tried. He was working hard, I'll tell you that. I think we could very well end up with a real trade deal where the tariffs wouldn't be necessary. We'll see.
Okay, so Mark, he was willing to potentially say that he's ready to make a deal with the UK. Did the UK have a playbook that Mexico and Canada should be copying here?
No. And the reality is that there are a couple of really interesting terms that the president uttered. First of all, I'd love to know what he means by a trade deal. Sounds like he wants something very narrow, and that is certainly not what the UK has wanted for many years now and was denied under the Biden administration, despite offering the US everything it could possibly have ever wanted. So I seriously doubt there's any lesson for Canada or Mexico, given what we just heard. But for Trump, it's going to be much harder to impose tariffs on the UK than it is given the narrative that he used to invoke the International Emergency Economic Powers Act against Canada, Mexico, and China. So I think the UK has less to fear, but I seriously doubt that the UK Prime Minister is going to head home thinking that he got something to settle his nerves and he won't have to worry anytime soon about forthcoming tariffs.
Fair enough. It's also interesting in the context of a post from the president on Truth Social this week talking about the severity of his focus on tariffs in the context of what's going on with the tit for tat with China. Do you expect any negotiating to happen with the U.S. and China moving forward on these tariffs, or is it going to be a continuation of this tit for tat?
I think it's great that China reached out to the newly confirmed USTR ambassador, Jameson Greer. That's certainly a sign of some goodwill. But no, I don't expect much negotiation. I expect that China, Canada, and Mexico will begin to firm up their retaliatory lists, despite the fact that, keep in mind, in the executive order, there is an escalation clause that President Trump inserted such that in the event that Canada and Mexico in particular were to retaliate, these numbers will not stay at 25%, and we will have an all-out trade war. And the retaliatory lists are not limited with respect to tariffs. Both Canada and Mexico are getting highly creative and threatening to take this in a very un-Canadian, un-Mexican way going forward. They are potentially going to invoke non-tariff barriers and do it in a very dramatic fashion. So look for this to escalate if, in fact, we see the tariffs go into play on Tuesday, which I expect we will.
And moving forward here, Mark, what investors really want to know is whether the brunt of the impact of these tariffs could potentially be softened by those upcoming potential tax cuts. What do you think of that, in your view, the kind of teeter-tatter between those two catalysts for the market?
It's really an unbelievable question if you think about it. The idea being that somehow he can compensate for the economic damage that he knows he's causing. So it would be great if President Trump were inspired to be a real pro-growth president and give us both no tariffs and tax cuts. The idea that these tariff salvos are going to generate enough income to replace or substantially reduce income taxes is bizarre, and certainly the math doesn't bear that out. But no, I don't expect that we are going to see some compensatory mechanism fully relieve us. And keep in mind, the damage has been done. The damage of these tariffs has already been done. They've seeded tremendous uncertainty. They've created a sense that the United States is no longer a trusted trade partner. And if I'm the UK Prime Minister flying back home, my first thought is it even worth the candle? What is a US trade deal if the obligations can so readily be thrown out the window? So the damage has been done. Investors have two fears. One is the number that the tariff comes in at, and the other is the uncertainty. The uncertainty is now going to be with us for a very long time.
All right, Mark, thank you so much for joining us this Friday morning. Really appreciate you breaking that down for us.
Thanks for having me.
Well, consumers and companies are bracing for the impact of President Trump's potential tariff policies. Trump confirming those additional tariffs on China will go into effect on Tuesday, alongside 25% tariffs on Mexico and Canada. The uncertainty already weighing on many Americans, causing consumer confidence to fall to the lowest level since August 2021, and pessimism about the future to reach a 10-month high. So how can businesses and consumers prepare for tariffs? Joining me now, we've got Andrew Siciliano, the leader of U.S. and global trade and customs practices at KPMG. Andrew, thanks for coming on set with us. We appreciate it.
Maddie, it's great to be here.
So talk to me about the single biggest takeaway for you, just in terms of how much leadership is concerned about tariffs right now. This is something we've been debating a lot this morning, whether or not the market cares about tariffs, whether or not CEOs care. How much do you think it's weighing on sentiment?
It's a significant concern. I mean, it feels like tariff uncertainty is the new normal right now. The president's only been in office for less than 40 days. We've had countless announcements on different tariffs from different countries, different products. So it remains to be seen. I was on a panel this week with a bunch of CFOs, and the comment that was made, I can't prepare for the long term when I don't know what the short term is going to yield. So we're at a point where it's the calm before the storm, and the storm may be coming next week, but we're still in the wait and see mode. The 10% China tariffs are the only real tariffs that have been implemented as of today. There's more to come. Not only in March, but in April, there's a slew and onslaught of potential more tariffs. So, like I said, the uncertainty is the new normal, and companies are still trying to brace with what to do. Tariffs policy is changing overnight, but supply chains don't.
Right.
So they can't really make any moves right now. It's a lot of wait and see. But some of the better companies are doing a lot of proactive planning.
Yeah. Let's go there. What are you seeing businesses do to prepare for those upcoming tariffs effectively?
Yeah, that's a good question. So it's really a big mix. The best companies that are handling this are the ones that have embedded trade strategy into their business model. They have chief trade officers, they have systems, they have data at their fingertips. So let's talk about data. I can't underestimate the importance of technology. Some companies don't even know what they pay in tariffs globally and can't determine the impact immediately. So what prudent companies who are ahead of the game on this, they have that data at their fingertips. We've been helping a lot of companies with a platform called Digital Gateway. We get all their trade data. As these changes are announcing, real-time impact analysis, looking at their data. So that's really, really important. You can't determine the impact if you don't have the data. Also, companies that have a diverse supply chain, being able to make those changes and monitor where you could go next if there is a huge tariff on a certain product. And then lastly, tariff optimization programs. There are a host of programs that companies could consider, if done properly, could really mitigate the tariff. So I could go on for a long time about that, but just to name a few, there's something called first sale for export, where you could pay tariffs on an earlier sale if there's multiple sales in the chain of transactions. Very popular program. It's only available in the United States, which is really pertinent right now for a lot of companies. So companies that never really paid tariffs before, in 2018 started implementing the first sale for export, and now a lot of companies are looking at it even more. Foreign trade zones. A foreign trade zone is an area outside of the customs territory. So just think about the potential impact of Canada and Mexico and the goods that are moving across the border. Sometimes an auto part, for example, could cross a border multiple times, sure. Right? So if you have a foreign trade zone that's outside the territory, those goods could move clear and free across borders without any impact. Another area is valuation. The tariff is assessed against the value, And sometimes that value is just the price paid for the goods without a lot of thought of what's really in that value. And what makes it even more complicated, when you have a related party transaction, that value is set by a transfer pricing team. So we work really closely with our transfer pricing team to make sure we're not, don't have a value that's too high for our clients, and they meet both the tax and customs rules.
All right, Andrew, we got to leave it there. Thank you so much for joining us. Andrew Siciliano over at KPMG. Thanks so much.
Thank you, Maddie.
Appreciate it. We'll be right back.
It is clear that the CFPB suffers from a crisis of legitimacy. This must be corrected if the CFPB is to reliably do what it's supposed to do, look out for the American consumer. To that noble end, the CFPB needs to be made accountable to our elected officials, and its past excesses need to come to an end.
That was President Trump's nominee for head of the Consumer Financial Protection Bureau speaking to the Senate Banking Committee yesterday, pledging he will follow the law and execute functions required by congressional statutes if confirmed as head of the agency. Despite that, employees of the agency claiming Elon Musk, Doge, and the Trump administration planning to fire the majority of the agency's 1,700 employees. Staff say that Doge and CFPB leadership met this month to discuss 3 phases of those layoffs, which you can see on your screen here. Moving forward here, we are speaking with Rohit Chopra, former head of the Consumer Financial Protection Bureau under President Biden. Rohit, great to have you on here. I want to jump in because we don't have a ton of time left. The Trump administration has cut back on the CFPB, shutting down offices, laying off staff. What is your biggest concern?
Well, I'm really worried about this effort to defund all of the police that look after Wall Street and big tech. You know, yesterday we heard that the CFPB essentially issued a series of corporate pardons, including to big companies like Capital One and a Berkshire Hathaway subsidiary accused of illegal lending. So there's big questions right now as to whether the market is going to shift on from meaningful competition to really figuring out how to bend the rules, cheat, and sidestep accountability.
And what do you think consumers need to know about the risks to them personally with these scale backs, especially given that under your purview in the CFPB, you were tough on enforcement, and now it seems that things are moving in the opposite direction?
Well, a lot more is going to shift to individual consumers where there are so many scams, there are so many ways in which our personal data is being heisted, essentially. So I don't have good advice other than to say, why on earth would we want a situation like this? President Trump actually campaigned on capping credit card interest rates, which I agree have really gotten out of control and are not really based on market interest rates or risks. It just seems almost predatory now. But instead, Capital One is getting a pardon, and the law enforcement agency that oversees the credit card industry is essentially being benched and sent home.
I know that you were also the FTC commissioner back in 2018, which of course was under President Trump's first term in office. What can you tell investors listening about what regulation might look like under Trump 2.0?
It's really interesting. I think a lot of investors are really scratching their head right now because I think they were really focused on a different regulatory environment where maybe certain things would be less stringent. But now what they're facing is just lots of chaos and questions. We're seeing a lot of indicators, not just consumer confidence, but business decision makers not really know, are we really heading into more uncertainty and fragility for the economy? So I think investors really have a lot to work through. And my hope is that there is not going to be a marketplace that incentivizes scam artists and fraudsters rather than honesty and competition.
All right, Rohit, we have to leave it there, but I really hope you'll come back with us and we can talk a little bit longer because we'd love to get more of your insights, especially about big tech coming into Washington. So thank you for making time for us this Friday morning. We appreciate it.
Thanks again.
Coming up, we've got wealth dedicated to all of your personal finance needs. Brad Smith has you for the next hour. I'll leave you with a quick check on the broader markets here. You've still got the S&P 500 and the NASDAQ in positive territory for the day, and we're still seeing those gains coming in here across the board, really looking like February might be on track to get out some gains before the end of the trading day. Have a great weekend.